If you're an entrepreneur in India, listen up, because there's been a pretty game-changing update to the rulebook. We're talking about a much simpler compliance path that means less time on red tape and way more time focusing on what really matters, growing your business. So let's just get right into it.
You know that feeling, right? If you're running a business, the endless forms, the complex regulations, it can honestly feel like you're spending more time on paperwork than on your actual company. But what if you could lighten that load, and get your focus back?
Well, now you can. The government has rolled out some key changes for businesses that qualify as a small company, and this unlocks a really powerful set of exemptions. And believe me, this is a massive advantage that can save you time, money, and just countless headaches.
So, that brings us to the first, and probably the most important question: what exactly is a small company? Well, the definition is super specific, and it all comes down to two key financial numbers.
To put it simply, a small company is just a private business that stays under two specific financial limits, one for its paid-up share capital and another for its annual turnover. If you can meet these new, higher thresholds, you basically unlock a world of benefits designed to make your life a whole lot easier.
Okay, first up is your paid-up share capital. Now, that's just the total money the company has gotten from shareholders in exchange for stock. To qualify, this amount has to be 10 crore rupees or less. This is a huge jump from the old limit, which, by the way, opens the door for so many more businesses.
And the second magic number is your annual turnover. This needs to be 100 crore rupees or less. So let's recap real quick. Paid-up capital up to 10 crores and turnover up to 100 crores. If your business fits into both of those, congratulations, you've qualified.
Now for the fun part. This is where it gets really exciting. Qualifying as a small company isn't just a label. It comes with some seriously valuable benefits that are going to directly impact your day-to-day operations.
Let's start with what is, arguably the single biggest advantage. You are completely exempt from the mandatory dematerialization of shares. What does that mean? It means you don't have to go through that often complex and pretty costly process of converting physical share certificates into electronic form. Huge.
So what does this exemption actually look like in practice? Well, you don't need an International Securities Identification Number, or ISIN. You're also exempt from filing that half-yearly form PAS-6, and you get to completely avoid the cost of appointing a registrar and transfer agent, or an RTA. This is just a massive operational and financial relief.
And the good news just keeps coming. Instead of 4 board meetings a year, you only need 2. You're no longer required to prepare a cash flow statement. Your annual return is a shorter, much simpler, abridged version. And you're exempt from compulsory auditor rotation. I mean, each one of these things seriously cuts down your administrative burden.
And believe it or not, there's even more. Your auditors don't have to report on your internal financial controls. You're exempt from that complex segment-wise reporting. You also get simpler rules for things like related party transactions and deciding on managerial pay. It's really a comprehensive package of relaxations.
Okay, now, before we get too carried away, it's really crucial to understand the fine print. There are a few conditions you absolutely need to meet to make sure you stay eligible for all these great benefits.
Just think of this as your quick 3-step eligibility check. First, you have to be totally up to date with all your filings, no defaults. Second, these benefits, they don't apply if you're a holding company or a subsidiary of a bigger non-small company. And third, for some of these perks, you need to meet the criteria for 2 years in a row. The key takeaway here, just maintain good standing, and that's your ticket to these advantages.
So let's bring this all together. What does all this regulatory language actually mean for your business's bottom line? Let's talk real-world impact.
The impact is direct and it's tangible. You're saving actual cash on RTA appointment fees, depository charges, and DMAT costs. Your professional fees for auditors and company secretaries will almost certainly drop, and your overall administrative overhead gets cut way down. This is money that goes straight back into your business.
And really, this is the whole philosophy behind these changes. It's about shifting your focus from navigating bureaucracy to what you do best: innovating, serving your customers, and growing your business. It's about empowering entrepreneurs to just get on with it.
So as we wrap up, let's focus on the real takeaway. By taking advantage of these new rules, you're not just saving money, you're buying back your most valuable asset, which is your time. So with all that extra time and energy, the only question left is, what will you build next? And just one final, very important note, please remember this information is for educational purposes. Compliance rules can be tricky and they do change, so you should always consult with a qualified professional for advice that's specific to your business. Thanks for joining us for this explainer.